One of the reasons why I like it so much is because you get leverage on the asset. Yes, we only put down 20%, but we get to eat all the gains on the whole entire property.
Did you ever wonder why savvy investors love real estate? Unlike most videos on this topic, I'm going to be going into the numbers and really breaking it down. I started investing this way back in 2009 when I first started to buy little rental properties. Today, we own well over $2.1 billion of rental real estate. That's well over 10,000 units. But we use the same type of ideals to rinse, wash, repeat in the portfolio today. And my goal for a lot of you guys is to get started, whether that's buying your first rental property, or if you're already an accredited investor, getting into syndications and private placements as an investor there. If you stay to the end of the video, there's also going to be a bonus multiplier there, which is forced appreciation. And we're going to be breaking that down too.
Hey folks, this is pretty much the reason why I invest in real estate and I got out of the stock market and all those types of investment. In my early 20s, buying my first rental property up in Seattle, Washington. Again, that's not a place we typically buy properties these days. We try and stay away from primary markets where rent to value ratios are over 1% so that we can cash flow. And the reason why cash flow is so important is because if there's any kind of recession, we hold on to the asset, because Warren Buffett says number one rule of investing is not losing any money. So when I was first investing in real estate, I realized I made 20 to 30% returns on my money. And I looked at my 401k stuff and I was making 8 to 10% there. And I was like, W2F, right? Who stole all my money? What happened here? I think a lot of you guys are probably thinking, how are you getting 20 to 30% plus returns on my money? And I'm going to show you it right here. 4 ways we're making money in rental real estate. The first one is cash flow. Second one, tenants are paying down your mortgage for you. And this is the key difference when you're buying a house on your own to live in. You're the sucker paying down your mortgage. When you have rental real estate, your tenants pay it down for you with their heart, sweat, and tears. And every time they pay down your mortgage, a little bit of that is going to your payment to principal. Yes, a lot of it is going to interest, but we'll get into the numbers here in a little bit. Thirdly are all the tax breaks that you get with rental real estate. Now, we're not going to get too much into this today, but I would suggest to go to /tax and see all the cool ways, especially when you're higher net worth, you're into syndication deals that do cost segregations. Now you're able to do a lot more tricks and with your taxes. But just for this straightforward example here, we're going to show you how we offset a lot of the gains. And lastly, appreciation. As cash flow investors, we don't really count on the price of the properties. We're mainly in it to cash flow. But hey, if it happens, awesome. Right? To us, it's icing on top of the cake. And this is very different from most amateur investors out there that buy a house in, say, the Bay Area. They buy it for $800,000 and maybe the next week it's worth $850,000. What I say to that is easy come, easy go. Appreciation is a gambler's game, especially when you don't do any work and effort. Easy come, easy goes. In the next recession, it's gone, and then you're underwater there. All right, so we're going to set this example up here, and I've got my calculator here to help me do the quick math. Every time I do this, I use a little bit different numbers, so apologize if some of the numbers aren't exactly super clean. The prototypical first investment that we have a lot of people do, or what I did, was a turnkey rental. You can buy properties, fix it up, do that BRRRR method, but I highly suggest not doing that, especially if you're a high-paid professional, you've got some money, but you're short on time. Yeah, you can make a lot of money doing that stuff, but it is risky, and I wouldn't probably advise doing it until you have a rental or two under your belt first. A turnkey rental is something that anybody can do starting out. What I would do is also check out our remote investor e-course. Check out my website to get free access to that. So buying a $100,000 house that rents for $1,000 a month, which is pretty typical once you get pretty good at finding pretty decent rental property deals out there. So on this $100,000 house, you're typically going to need to put down 20% down payment. So 20% on $100,000 is you're going to need $20,000. That's your initial investment, and that's what we're going to use as the denominator for a lot of our returns, because the return on investment is essentially how much money you made divided by the denominator, which is how much money you had in the deal, which is $20,000. So if you're cash flowing on this property using this 50% rule that a lot of people like to use to be conservative, which says if you're bringing in $1,000 a month as revenue, you're typically going to be putting out half of that, 50%, to expenses, repairs, maintenance, third-party property management, which is a key because we're busy. We want to outsource this stuff to professionals, especially when you're doing this remotely. I don't know how to do an eviction. I've never personally done it because every time we use third-party professional property managers. We also do that not only for the obvious reasons of litigation, liability. This is the way to scale. And this is what separates the difference between somebody who owns a property or two and somebody who can scale to dozens and dozens of rental properties and get financially free that way. So a lot of times I tell people on a turnkey rental, you're probably going to cash flow maybe $200 at the end of the month, with half of the $1,000 going to repairs, maintenance, CapEx, rainy day fund, vacancy, property management. And then you need to pay your principal, interest, taxes, insurance, or in other known as your mortgage payment. You're going to have a couple $100 of cash flow at the end of the month. We're trying to be conservative here in this estimation, $200 a month, and that is going to be times 12. So that's going to be $2,400 a year. So the math goes like this. $2,400 divided by how much money did you have in the down payment? So $20,000. And that is equal to 12%. That alone right there is greater than what you're getting in the 8 to 10%. So at this point, we should probably just stop the video because this is greater than what's in the stock market in a hard asset that you control, and that this cash flow is only going to be going up over the life of the loan. But let's continue on, right? Because after this point, it's all gravy. We're just going to accumulate to this 12%. Next is principal pay down. So when you're starting with these properties, I'm going to estimate in my head that principal, interest, taxes, insurance, mortgage payment is going to be about $400 or $500 a month. Most of that's going to be going to the bank as interest. Of that, I would probably estimate that about $100 of that in the beginning is going to be going down to your payment to principal. And that's essentially going to be building up for you as equity as you start to pay down your loan. In the beginning, it's very small, 1/4 of your mortgage payment. But as time goes along, of course, this increases. But for now, let's just go with the most conservative number. So again, out of your principal payment of $500 a month, only $100 probably goes to your payment to principal. And therefore, now you're making $1,200 a year. Same equation here. Take how much money you made divided by 20K as your denominator. And that is going to be equal to 6%. So already you go 12% plus 6%. We're already at 18%. Let's keep going. Tax benefits. On this property, you're going to be able to depreciate the property improvement in 27 years. So 1/27th the property value. The property value of this thing is $100,000. In a lot of cases, 60 to 70% of the property value is the building improvement. Now, this might be different in high-price areas like Seattle, California, Hawaii, where you might be looking at less than half of the market value contributed to the building improvement portion. But in a lot of these areas like, Texas, Alabama, Arizona, Florida, places like that, the land isn't as big of a ratio than it is in a lot of the places that we're used to living. So just for this estimation for this property, it's $60,000 is the building improvement. I'm going to divide that number by 27 years to get me the number that I can deduct off my taxes as paper losses or depreciation. So that number is $2,222 per year. It's not a deduction off your taxable debt, but it's a deduction that you can deduct off your income. So everybody's in different income levels. So a lot of people might be in the $100,000 adjusted gross income range or less. That's where I was when I initially started to invest in real estate. For a lot of you guys might be paying anywhere from 20 to 25% tax rate. So let's just go with 25% because it's a nice clean number. So the way I'm doing my math here is you're going to have this deduction off your adjusted gross income. At 25% of that is approximately $555 of tax savings per year. And you divide that by $20,000. Now, this is a very small part of the gains. We always add it in here. So that's about 2.7%. The next thing is appreciation. And this is probably the most volatile of all. Things go up in price, things go down in price. But typically across the country, home values go up 2 to 3% per year. Let's just take 2% because we're typically investing in areas that don't skyrocket in price. Instead of more like bipolar type of environments where you have big spikes and big crashes, like California, a lot of these high price areas, a lot of places that we invest in, they're a little bit more slower appreciation and what we call less cyclical states. Cyclical meaning it goes up and down. We call these more linear type of progression of values. So I'm going to use the estimation of 2% property increasing every year. So on a $100,000 property, 2% is approximately $2,000, even though we're only had 20%. And this is a cool part about owning real estate when you're using other people's money, such as Fannie Mae, Freddie Mac, government-sponsored loans. So here we made $2,000 on the $20,000. Same equation we were doing back then. $2,000 to buy 20 grand. Now that is another 10% gains. What we're doing here is we're adding up this number and this number. 12 plus 6 plus 2.7 plus 10. And that is 30.7% gains. And I'd like to think that the appreciation, we could have easily bumped that up to 3%. The tax benefits, you might have been in a higher income bracket, and that tax benefits would probably be greater for you too. Principal pay down over the years, it's going to go higher. And the cash flow, one thing that doesn't really go down are rents. And we've seen that through the pandemic and other environments. If you're a renter, rent is going to keep going up and up. So you add all this up, and now you're talking about 30.7%. Now, why would I want to put my money into any kind of stocks, mutual funds, making 8 to 10%? And this is where, in my 20s, I was like, the heck was happening, right? Why would I want to do that? Why does everybody put their money blindly in the retail investing market? All these companies got in cahoots with the government to get all your 401k money in there. I'm not going to go down that rabbit hole, but as far as I'm concerned, if something's going to give me 30% returns on my money, I'm going to do that. But the problem here is educating yourself. Buying a rental property, it's not easy, but it is simple. But now we're going to add on the 3 other bonus ways we also make money with all this. We talked about 30% returns on money greater than what you're getting out there in the retail investing market. But there's 3 things that's really hard to quantify that gets us even more returns. And when you invest, you get out of rental properties and you start to get into more commercial assets, this is where your returns really go up. But before I get there, inflation is a big thing here. And this is really hard to quantify because there's a lot of phantom stats. The government would like you to believe that it's anywhere from 2 to 3%. But I think a lot of us have seen our dollar devalued over time. Just look at the basic commodities such as your gasoline, your house, just basic commodities. I would say the one thing that doesn't really feel like it is technology items, and that's just because of Moore's Law and how commuting speed gets faster. But why is inflation such a big thing? The government's printing money like there's no tomorrow. How is the government going to pay for all these government entitlement programs? The one way that they're going to be doing that is raising taxes, and that makes people upset. When people are upset, they stop voting for their politicians, and they can only push up taxes so much before people really start to get pissed off. The second biggest way that they can raise extra money is to go into debt, print all this money, but then devalue the debt over time by inflating the money supply. And this is actually really smart, and this is what sophisticated banks and governments do. Unfortunately, you got in their heads where debt is really bad. We're all taught we don't want to be a slave to anybody, we don't owe money. But financially sophisticated people go into debt where they buy assets such as real estate so they can pay their debt service, and they just wait over time for the inflation to erode their debt. By picking up a 30-year mortgage or any mortgage that holds a good asset like real estate is probably one of the best things you can do to hedge yourself against inflation coming. In other words, if you don't have debt to your name, good debt, not including all the bad consumer debt out there, like credit cards, car loans, such as that, your wealth is eroding over time. And this is unfortunate. A lot of older people, they have paid off houses. Their wealth is just decaying over time as inflation engulfs them. So what you're doing when you buy this rental property, again, going back to the past example, at 20% down payment, you're taking out an $80,000 loan. Over time, 20, 30 years, that $80,000 is going to be absolutely nothing at that point. Forget the fact that you're paying it off, right? Even if you didn't pay off, you paid it off at an interest-free type of loan, that $80,000 is going to feel like nothing in 10, 20, 30 years from now. So that's, again, really hard to quantify. If I was going to quantify using the same metrics as we did on the other side, I'd probably use an inflation model of 2%, even though I could probably make the argument that inflation is really going up 4, 5, 6% every year. So, 2% on $80,000, that's $1,600 a year. $1,600 divided by that $20,000 initial investment is another 8% return on investment that I'd probably add to that number. Now, a lot of you guys who are like reading these like podcasts and watching these videos might make an argument. Cool. Put a comment below, right? Let's get into a conversation here. Next thing that I wanted to go over as another hidden bonus of buying rental real estate, being the beneficiary of that, is buying low, sell high. When you're a turnkey rental owner, a lot of times you're buying right at the retail price, which sucks. Which is why we like to buy assets that are out of the grasp of unsophisticated mom and pop investors. This is why we like to stay above 50 to 100 units or above, ideally in 200 to 300 unit apartment complex, because there's not too much of competition in that kind of stratosphere. And a lot of times we can buy properties for anywhere from 5% discount, which doesn't sound like much, but when you're talking 100, 200, 300 units, that built-in discount comes directly to our bottom line. I'm not going to put that there. Now you're talking a little bit about fantasy numbers in terms of return on investments, but ideally that's what you want to be doing, right? And that's just gravy all on top of this. The last way that I wanted to bring to your guys' attention, we talked about appreciation on the other slide. The natural pace of inflation that kind of pushes up prices of properties. Now there's two types of appreciation. Market appreciation and forced appreciation. Market appreciation is dumb luck. That's like your unsophisticated friend who just bought a house the other day and now he's telling everybody it's worth 10% more. What we're talking about is forced appreciation. What we do is we rehab units and we bump the price of the rents up. In commercial real estate, the price of the property is dictated by the net operating income and divided by the current prevailing cap rate. Let's just go by a 5% cap for a Class B apartment in a major market. And this is what the property will sell for, or the property should appraise for. In residential real estate, a lot of the times it's based on emotion, the demand versus supply phenomenon, what the neighbor's house sold for in the area. There's not based on numbers. And this is why I like commercial properties as opposed to residential properties. But with residential properties, as you guys know, you guys can rehab properties for flip properties, which we don't like to do here because it's a little bit too much work. And there's just too much competition with so many amateur flippers out there trying to buy properties too high. And they're just not sophisticated enough and taking all the good contractors out there. But with commercial real estate, we like to go in with a little bit of facelift. New flooring, new appliances, new countertops, maybe some playground equipment, some power washing, some new flowers in the flower beds. Nothing crazy. Nothing like a $20,000, $30,000 plus rehab or bigger. Like we're usually in the $4,000 to $6,000 per unit range. And the reason why it's so little bit is we're doing it on large economies of scale. It's 100, 200 plus units. And what we're doing is we're making that little improvement, and therefore we're able to bump up the rents a little bit, anywhere from 5 to 15%. So if I'm able to raise the price of the rents by 10%, effectively what I've done is raise the price of the net operating income, which is the income minus expenses. Say I have a property that rents for $1,000 a month. If I increase the price of the rents by 10%, which is $100 a month on, let's just say 100 units, $100 a month times 100 units. And granted, this is not going to be overnight. This will typically take maybe 2 to 3 years to happen. I've effectively created $10,000 of extra net operating income per month. So what I want to do is multiply that by 12, and I get $120,000 in extra net operating income per year. And I plug that into the equation here. 120K goes here. Divide that by a cap rate of 5. And what I've done is I've appreciated this 100 unit building by $2.4 million. And that is forced appreciation. That is not market appreciation. Maybe if the market got stronger, you add that on top of that right there. Forced appreciation, why I like it is you're creating value. You're taking faith in your own hand. You're not just relying on the market. You just created $2.4 million of value right there. And that's probably going to be a lot more than a market, especially a stabilized asset, can go down in value. That's what a real business does. A real business adds value. It improves the product. A lot of people talk about buying and selling things on Amazon, selling stocks, short calls, all this type of stuff. But to me, it's not a legitimate business because it doesn't improve things for other people. It doesn't add value to the system. What we're doing here is we're rehabbing units, increasing the value of the properties incrementally, so tenants pay a little bit more, right? And that's where we're getting this net operating income boost. And something I've learned from a lot of high net worth people is wealth comes to those people who create value. There are people who trade money and can make a little bit of money here or there, but sustainable wealth comes to those people who create value. So again, if you guys are looking at buying a rental property, pay attention to the numbers on the first page, 30% returns on your money. Compare that with the stock market, something that goes up and down very cyclically. If you guys are higher net worth into commercial real estate investing, check out /syndication. If you guys have any questions on these numbers, put a comment down below. And if you guys got any value out of this, click the like button. I'll see you guys next time. If you guys are probably wondering what's on my shirt, PCPO, which stands for Passive Cash Flow Pays Off. And it does. See you guys next time. Bye.
Going through this whole transition myself, it was really hard to do it without meeting other purely passive accredited investors out there. So that's why we've created the network, which you guys can join.